Hey guys, Boris Awesome. Welcome to our Forex weekly technicals for 324, 329 of 2014. Where are the trades? Interesting week this week. We definitely had the down move in the euro as we thought we might. Technically, of course, we talked about the fact that this spike out wick was operating as the resistance point in the euro for a couple of weeks now, and every rally was a sell. And it turned out to be pretty accurate. Every rally was a sell. Euro got clobbered post FOMC and had a little bit of a follow through even post FOMC. So now 37.50 seems to be the key support level, and there is quite a lot of support here. You see that this was a big resistance level prior that now becomes, of course, support. And so far it's holding, but the move today has really been capped by the 38 handle. And unless we start to kind of take out the highs over here, which is really 38.50, every rally here is very anemic and still suggests we have further selling to do. A break of the 37.50 definitely opens up the prospect of 37, which is a pretty decent support level, and then ultimately 36.50, which is the better support level over here from a prior level of resistance at the beginning of the year. So euro still looks to be in a distributive mode, but of course next week we have a couple of key economic indicators. We have the Eurozone PMI data and we have the IFO data. If both of those show significant deterioration, the pressure on the ECB to begin to ease and to begin to perhaps even entertain the concept of QE certainly is going to escalate tremendously. And I think in that sense, the euro still looks relatively vulnerable to the downside and looks potentially to be a sell rather than a buy as we enter next week. A big turn, however, though, and a close above 38.50 would negate this bearish bias and put us much more into a neutral position. But for the time being, it's still very much a sell the rally mode as it has been for the last week and a half. Dollar yen, surprisingly weaker than you would have thought. We've had relatively decent risk. We've had certainly very more hawkish than expected Fed raise in U.S. rates, and yet dollar yen cannot get out of its way. This 102.50 seems to be big resistance level. And as you can see, we're basically just consolidating. It's still indeterminate whether it's a full downward collapse or whether this is simply a pause and an upside break. It looks actually very neutral, and you can't really make a definitive statement as to which way it wants to go, but it really does need to close above these highs over here. Certainly, it needs, if it can clear 103 and close above 103, we would have a much more bullish structure in the pair that would suggest that we're now making higher lows and a potential build-up to a run towards the season highs at 105.50. If, however, we continue to be suffering and really can't close above 103, the longer we go here, the more distributive it seems, and then, of course, it becomes a test of the 101, 101.50, 100 level that we've had prior. This has been a strong support level. It's basically a quadruple bottom over here. But still, the fact that we're going to be testing this again suggests that there may be more pressure to the downside. And of course, a break here, a break below 150, could trigger a massive run down because it could make the 100 level very vulnerable. And it looks like there's probably going to be a tremendous amount of stops at the 100 level for long-term longs that are going to start to bail. Overall, it does not look pretty for the yen because you're basically seeing a series of lower highs, which is indicative of a distributive pattern. And again, a break below this 101.50 level suggests further distribution to the downside. So the interesting thing here is you could take a punt on the short side with a very definitive stop here at 103. In other words, if we take out 103, you're pretty much wrong to the short side. But as long as we stay underneath the 103 level, the short may be the operative trade here. Certainly at least the 101.50 where we test the support as we go forward. Cable is sort of similar to euro, starting to show a little bit of weakness. Definitely looking much more distributive than it was even a week ago. We gave up the 66s, we gave up the 65s, the 64.50 key level of support, and then of course it opens up the much bigger support here at 64, which was a consolidative level really from the beginning of the year, from which we made the first spring, then a correction, then a second move higher. So 64 looks to be a lot more chunky, and very likely that between 63.50, 64, we're going to find some short-term support. But in the meantime, there's still about 150 points to the downside in cable that could occur before we get to that support level. Aussie, on the other hand, has definitely looked much better, but you must be cautious about getting a little bullish on the Aussie here, for a simple reason that this 91 just refuses to kind of provide any breakout possibility. It's been actually a capping level for pretty much most of the month. So similar story in the Aussie as in the yen. You have to prove that it's really a buy by having it take out this 91.30, 91.40 level. And that could be an interesting dilemma for Aussie longs. So in the meantime, again, if you're a short, it's a relatively small risk here because basically 91.50 you're wrong, but you're not very far, it's not that much of a risk. And it could be another false dawn, another false move in the Aussie. Not too much data. Certainly the Aussie is getting a lot of boost from the fact that the RBA looks like it's going to remain stationary and the fact that risk flows look to be okay. But any kind of geopolitical tension, any sort of further troubles out of China that looked much more severe, let's say not the small defaults that we're seeing, but a major default that could send ripples through the Chinese markets, could definitely make the Aussie wobble, and we come back to the 89 support level. 90 is support, but really it's 89 that is the big support here, and that's where the Aussie is going to try to make a hold stand if we start to correct. But from the short side, again, this 91.50 makes you wrong, but until that point, you may potentially have a trade here to the short side. Now, the other interesting thing that happened this week was this complete change of trend in dollar CAD. Dollar CAD got faked out, I think, in many ways on the very dovish BOC during the week, with Paulos basically signaling that inflation was going to be low, that retail sales were going to be weak, and then lo and behold, today the data was much better than expected. So for now, the interesting thing about dollar CAD is whether it's made a near-term top right underneath this 1300 level. Really, basically, dollar CAD is kind of an interesting sell the rallies trade with 113 as the cap, in terms of trying to pick a top here. What is encouraging for bulls is the fact that even though we had very good data, dollar CAD really ended up as pretty much close to the day's opening, not on the day's lows. And that is concerning if you want to try to short this pair, because it suggests that irrespective of whatever data was today, market is still very negative loony, and we could take out the highs here. So you certainly don't want to be long, you don't want to be short this thing for too long. But as long as we stay sort of underneath the 1300, there may be a possibility here for a drift a little further. Another way of looking at this is if you want to get short is just to simply stay out of the way until the lows here are broken, which is around, I think, 1175 or so. So it's sort of the idea that if you want to have a confirmed short, you want to take out the lows here and then try to target the 1100 level as a little bit of a profit covering, sort of profit-taking rally in a dollar CAD trade. And then last but not least, the Kiwi has just been a little bit of a sideshow for most of the week. We took out the 86s and it came right back down post the RBNZ. I think part of the reason why the Kiwi is not acting as strongly as you might expect it to be is because now there is some speculation that the tightening priced in by the market may be a little too aggressive. That the RBNZ did tighten, but their pace of tightening, their rate of tightening is going to be slower than what the market thinks. I think the market had about 192 basis points or 119 basis points of tightening factored in, and it may only be 75 basis points of real tightening the RBNZ does. So there is a definitely profit-taking move here taking shape in the Kiwi. One of the interesting things to look at here, I think, from a cross point of view on a longer-term trade is this, which, we've been talking about the fact that this has definitely been making a bottom here at the 105, and today we saw a very decent breakout above this 106 level, and that suggests that even if we have a little bit of profit-taking in the Aussie Kiwi trade may be the best way to trade Aussie strength next week, because it could provide you, it could basically buffet you away from the dollar action and provide you a little bit of strength on the cross. 107 is the natural target here, and it's not like it's going to soar to the sky, but still there's very decent potential here, given the fact that we've had a nice strong breakout here to move to 107, maybe 107.50 as the week progresses. And then looking around on the euro crosses here, the other thing that we looked at also, I think, last week was the bottoming out action in euro Swiss. Still remains relatively decent as a bottom here, certainly at 21.50. But at the same time, not too much follow through. The move from 21.50 was only good for about 50 basis points for 2200, and we kind of found ourselves tapped out here. As long as we stay above 21.50, it's a relatively bullish formation. You have higher lows and a potential rerun towards the 2200. But now the trade is not nearly as interesting as it was last week, when it looked much more confirmative. On the crosses, the other thing that's kind of interesting is the euro pound topping out move. So the euro pound definitely had this big short covering move here to 8,400, and then we clearly had a little bit of profit taking and a little bit of resistance at this 8,400 level. Next week, it's really going to be an interesting question whether the euro becomes relatively weak. In a sense, what if we have weak European data, stronger speculation the ECB is going to do something dramatic at the week following ECB meeting? That definitely puts the pressure on the euro across the crosses, and certainly puts the pressure on the euro across the pound. So watching these levels here, the low here, the spike low was what, about 83.42? Is that what it looks like? Yeah, 83.25, basically 83.25. A break of the 83.25 really confirms to us a topping out formation and a move back down towards the 82.50 support level that we saw earlier in the month. So that's kind of how the week shapes up. There are definitely some interesting trades. Perhaps the most interesting trades are going to be on the crosses, but generally watching Euro and watching Aussie next week is probably going to be the big stories and the big headlines of where the movement's going to be. Wishing you guys the best of luck, the best of trading. Boris Schlossberg, over and out.